Welcome back, econ enthusiasts. Today we are diving into the Federal Reserve's latest dance routine. And no, it's not a cha-cha-cha, it's the inflation ballet. So the CPI data for April 2024 just dropped, and it's showing a slightly cooler inflation trend. Shelter and energy prices are the main stars here, making significant contributions. But just like a dance off, not everyone is in synchronization. Food prices are doing their own thing, with some going up and others going down. And check this out, motor vehicle insurance and used cars, there are wild cards with significant yearly changes. Let's see how the Fed choreographs makes the next moves. Please let me know if you in your comments whether you expect no landing, soft landing, hard landing, or you agree, or whether you agree with me with a slow motion landing. All right, now let's talk about Taylor Swift. Well, I wanted to say the Taylor rule, though she does have a song for every economic mood, I guess. The Taylor rule is a formula central bankers use to decide the ideal interest rate. It factors in things like the current inflation rate, PCE minus 2%, personal consumption index, expenditure, the natural interest rate, basically the normal rate, and how far off we are from full employment and inflation targets. Think of it as a recipe where you mix current Fed rates, inflation gaps, and economic slack to get the perfect interest rate souffle. It's all about balancing the economy, just like balancing on a tightrope. The Fed looks now at mitigating shortfalls of employment versus mitigating deviations of unemployment. And I think this is important for the Taylor rule. So mitigating the shortfalls means focusing on helping people who are willing and able to work but can't find jobs. It's about addressing gaps where employment falls short of the maximum levels of economy. And not the Fed is not looking anymore to deviations for the unemployment rate. This approach was more about correcting any deviations from the ideal unemployment rate. If unemployment was above or below the target, the Fed will adjust its policies. This method treated any deviation, high or low, as equally important, and that is actually not happening anymore. So at least from 2020, which is very important to get to know that the shortfalls are actually important for the Fed, although look, the Fed do not really have or has the toolbox or the tools to fight like different type of unemployment, right? Like, or different sectors. That is, I think, my opinion, more of a fiscal policy rather than monetary policy or something that you can do from the central bank. Anyway, they can steer the economy to help people in general to try to mitigate the shortfalls in employment. Here we have then the Taylor rule. This is the equation. As you can see on this slide, we have first of all the federal fund rates which equal the federal rate in times t minus 1, the previous federal fund rate, and here we have the natural interest rate minus 2%, the PCE minus 2%, which is the target, and we also take into account gap measures. Can be the GDP gap or any labor gap or etc. It can be any gap in the economy to try to measure the performance in the economy different from the performance in inflation and the performance in terms of natural interest rate. Let's dive into this colorful chart that looks like an economic roller coaster. It shows the actual federal fund rates compared to what the Taylor rule suggests. The Taylor rule is like a GPS for the Fed, helping them decide the right interest rate based on economic conditions. The formula factors in current interests, where we are now, inflation rates, how far we are from the 2% target, and the economic output. This is the gap where the economy is and where it could be operating at full potential. In the chart, the purple line represents the actual Fed funds rate, while the other lines, the green and orange ones, show different Taylor rule prescriptions under various scenarios. For example, alternative 1 might assume the economy needs more support, suggesting a lower rate, whereas alternative 2 could be more conservative, recommending a higher rate. Right now, the average suggested rate is around 4.72%, but the Fed's actual rate decisions also consider real-time data and broader economic uncertainties. This helps them navigate between the risk of high inflation and sluggish growth. It's a balancing act, like walking a tightrope, and the Taylor rule is their safety net. So remember, here we are at 4.72. That is the middle or the median one, the one that I actually calculated. And the federal fund rate is 5.25, meaning that actually possibly we are just like 50 basic points up from where we are now. So we are actually not really very high in terms of interest rates at the moment. It's fairly close to these estimates, but obviously if there is a problem, lower inflation, I think the conditions are given for a decrease in interest rates. In my opinion, the economy is in a slow cooking at the moment. So I will not foresee like a lot of fluctuations. Rather than I will expect more like a process of cooling down slowly. So with inflation moderating and growth stabilizing, the Fed uses this rule to adjust rates carefully. If the inflation rate exceeds the target, the rule suggests higher rates to cool down the economy. Conversely, if growth lags, lower rates are recommended to stimulate borrowing and investments. Why this matters? Understanding this Taylor rule and how the Fed uses it can demystify our decisions, showing us the careful calibration behind every rate change. It's not just about numbers, it's about maintaining economic stability and fostering sustainable growth at the same time. Let's put on our forecasting hats and dive into some predictions. Here is my take on what's next for the economy. I believe that interest rates have peaked. The Fed has been hiking interest rates to tame inflation, and it looks like they have reached the peak. Why? Because inflation is showing signs of moderating or at least being flat at the moment, generating like the call for patience that we can see not just from Jerome Powell, but many other Fed presidents. Because inflation is showing slides of moderating and the economy is cooling down, higher rates have already made borrowing more expensive, slowing down consumer spending and business investments. The Fed might hold steady for a while to see what happens and how things play out. I am bullish on treasuries, with rates high, the treasury bonds becomes more attractive, and also I think the only way for the Fed is to decrease the interest rates, which obviously you know that bonds, interest rates and prices are opposite. So if we see a decrease in interest rates, prices of treasuries shall go up. So that is why I am I am very bullish really on treasuries. So investors looking for safer returns might flock as well to treasuries, driving their prices up as inflation cools. The yields, interest payments on these bonds become even more appealing. It's like finding a good deal on your favorite brand of cereal, reliable and rewarding. In my opinion, equity sectors shall decrease, or possibly we are going to see a divide. So not all stock market sectors will perform equally. Big companies in tech and healthcare might continue to shine due to ongoing innovations and demand. On the flip side, sectors like consumer discretionary and real estate might struggle when the interest rates are higher for longer. If they start decreasing the interest rates, I think I will become more bullish on real estate. Might look at these sectors, specific sectors, to start loading on them. Yes, think of it like a sports league. Some teams, sectors are on a winning streak, while others face tough seasons. So I think the divide will persist. Particularly, I like big names rather than small names, because big names are more safe in terms of finding capital, borrowing, and small players are possibly having to pay more or higher interest rates, and liquidity for them is possibly at this time very difficult. Another thing is that serious accidents may happen, and that is another thing why I'm bullish in treasuries. It's as well like safeguarding my investments, because yes, an accident can happen anytime. Geopolitical accidents and as well liquidity or credit accidents. So economic surprises may occur. Policy changes, major market shifts could cause turbulence. Remember the ever-given chip blocking on the Suez Canal, and even single events can have widespread events. So say Russia and its war rhetoric, and not just with Ukraine, but now starting with other countries in the world. So I prefer to be prepared at this moment for unexpected, and now that I believe that interest rates peak, I think it makes a lot of sense. So the last time the Federal Reserve increased the interest rates was in July 2023, when they raised the federal funds rate to a range of 5.25 to 5.50%. Since then, the Fed has opted to hold rates steady in subsequent meetings, including those in January and March 2024, maintaining the same range to evaluate further economic data and trends. The Federal Reserve, Jay Powell, exhibited like a dovish stance in his commentary following the Fed's policy announcement. This approach stood in stark contrast with the policy statement itself, which suggested a tougher stance on inflation. My concern is that both forecasts and actual values are flat, as you can see on this graph. You can see how flat we are at the moment. Yes, and actually, if you can see here, in July, we stopped increasing the interest rates at this point, and afterwards, actually, inflation has not fallen dramatically. It has been more flat, around between 3 and 4%. So the Fed's data-driven dance will possibly take more than expected, and look at how flat are these readings since the last time the Fed increased the interest rates. The CPI year-over-year graph that we are seeing, it has been a real roller coaster, from nearly 9% to a more manageable 3.4% last reading. The Fed's last rate hike was in July 2023, and since then they've been holding steady. Powell's recent comments suggest a cautious, data-driven approach. The takeaway: the Fed's dance with data is far from over, and we'll need to keep an eye on these trends because we need to see how they steer the economy. Now let's look into the world of inflation nowcasting. Nowcasting is like forecasting, but in real time. This gives us like a sneak peek into current economic conditions. The Federal Reserve Bank of Cleveland uses a model based on data from the Bureau of Labor Statistics to predict inflation. Here is the scoop. Their model was predicting around 3.8% inflation, but the actual release was spot on 3.4%. This difference shows the challenge of predicting economic conditions precisely. Even expert polls like the one from Reuters hits bullseye with their median prediction of 3.4%. The markets reacted, I think, in my opinion, possibly they overreacted, because yes, it was actually a bullseye on a prediction rather than a 3.8%. I think they got happy about it, but possibly too happy, because the Dow Jones, for instance, is at record levels. So what does this mean? The data suggests that inflation is moving sideways rather than heading straight down to the Fed's 2% target. Think of it has a Fed's dance with inflation being in a slow motion right now. They are taking it step by step, trying to ensure the economy doesn't trip up. The last bit, the run from 3.4% to 2%, I think possibly we'll have to have like a lot of consideration. We might crash the economy if the Fed persists in the 2% target, which is a shame. Like increasing the target might hit the credibility, yes, but anyway, I think going through the 2% target is going to be very, very painful. Okay, let's see what happens. Let's talk about companies, or how companies are reacting to inflation. I searched through the earning calls transcripts using a FactSet AI, and the Standard & Poor's 500 companies show that among all these Standard & Poor's 500 companies, only 219 companies mentioned inflation in their transcripts. And this is the lowest number since the Q2 2021. It's like inflation talk at the office water cooler is finally dying down. However, this figure comes as well with a lot of comments. 219 mentions are still above the 10-year average of 180, slightly higher. So while fewer companies are boasting about inflation, it's not entirely out of the picture. With 30 companies yet to report, and will inflation chatter pick up? Well, I don't think so, because there are just 30 companies and the previous reading was actually 289. But we are not going to reach that level. What this is showing is that companies are assimilating better a level of inflation around 3.4%, 3%. I guess so, yes, but possibly that will mean that inflation is no longer a concern and that 3.4%, 3% is the new normal. Personally, I would be cautious about investing in sectors like financials, industrials, and consumer staples, which are heavily impacted by a prolonged inflation. Well, financials are actually increasing, but at what point the clients of these companies are going to start uh, to stop paying their installments and getting into problems. It's very difficult to know. So McDonald's, for instance, highlighted challenges that with consumer spending, food costs, and labor expenses in their recent earnings call. So we need to keep a close eye on these sectors, financial, industrial, and consumer staples, because if the conditions continue as they are, we might see a spike in problems from the consumer side, the consumer spending side, and indebtedness side. So let's decode the latest inflation patterns. In April, the overall CPI showed a slight decrease in monthly rate from 0.4% in March to 0.3%. This indicates a potential slowdown in inflation with the yearly rate at 3.4%. What are the key contributors to monthly changes? Shelter and gasoline. These were the major contributors to the monthly increase. Shelter costs are consistently rising and gasoline prices have seen a notable uptick. Energy. Energy prices increased, particularly gasoline. Food. The food index was unchanged overall, but we saw mixed movements within food categories. What are the significant yearly increases? Shelter, motor vehicle insurance, which showed a significant yearly increase of 22.6%, energy 2.6%, and these ones are the ones that have deflationary pressures, because deflation is as well a scenario that can come. Deflation might make the interest rates decrease and treasuries go ballistic up. So I think this scenario will be actually good for me, not as well for us as households of any economy. So the deflationary pressures are in used cars and trucks, with a notable drop of 6.9%, natural gas and fuel oil. Both show yearly decreases reflecting lower energy costs. So inflation is actually at the moment a mixed bag, with some categories rising and others falling. It's like trying to balance on a seesaw, challenging but not impossible. So check out this chart on the percentage change in the consumer price index across various categories over the past 12 months. Here is the breakdown. All items up around 3.4%, indicating overall inflation. Check out this: education and communication fairly stable, slight changes. This is remarkable. I think particularly education in the UK, possibly in the US as well, are sectors that are not doing very well, especially in the price section. They just cannot increase prices more. So medical care, they have a moderate increase, reflecting rising in health costs. And I think these two sectors are actually, education and medical care, are actually in a mini crisis. Apparel is relatively stable with minor fluctuations, recreation a moderate increase, food and beverages a significant increase, especially in food costs, Transportation has a sharp increase driven by higher fuel prices. Housing continues to rise, reflecting ongoing market pressures, and other goods and services have a moderate increase. So I think understanding these categories help us to see where inflation hits the hardest, helping us to make informed decisions about spending and investments. Finally, let's look at how the market reacted to Fed's decision to keep the rates steady. When Fed Chair Jerome Powell signaled a cautious stance, the markets experienced a brief burst of optimism. Interest rates dipped and stock price rallied, like quick sugar rush. You can see it here on this picture. However, these effects were short-lived. Subsequent economic data, particularly weaker employee numbers, validated Powell's caution approach, and I think the latest CPI as well. This led to the first simultaneous weekly gain for the Standard & Poor's and Treasury in over a month at the same time. Standard & Poor's and Treasury is actually picking up. So Powell's message was clear. It's unlikely that the next policy rate move will be a hike. This indicates a wait-and-see approach as the Fed evaluates the impact of current rates on the economy. So while the market had a moment of excitement, it's now back, I think, to a cautious optimism. Yes, so the economic indicators have been increasingly contradictory. So labor costs have soared significantly, indicating potential inflationary pressures. Wage growth reports just days later suggested an easing on this front. And other economic measures present a similarly confusing scenario, with retail sales rising and then recently dropping to zero, and in line with a slowing GDP. An increased industrial production despite a manufacturing slowdown. The US GDP growth rate is indeed slowing according to the Bureau of Economic Analysis, and the real GDP increased at an annual rate of 1.6% in the first quarter of 2024, down significantly from a 3.4% increase in the fourth quarter of 2023. So it is a huge cool down. And I think this is a bit worrisome for the chess, especially next quarter. What is the actual pace at which GDP is falling? Well, it's a huge pace. So, moreover, the Federal Reserve, Bank of St. Louis, and other private sector forecasters project that GDP growth will continue to slow down in 2024. So elevated inflation and higher interest rates are contributing to this slowdown, following the conference board, with an expectation that the GDP growth will dip below 1% in the coming quarters. If this happens, guys, that means that earnings the next quarters are going to be challenging, not to say possibly bad. So future earnings might look less positive than the previous quarter that I think was remarkable, right? Quite remarkable. So Chairman Powell's remarks shed light on the strategic measured approach to policy making, advocating for a careful balance between reacting to immediate economic changes and maintaining a steady course towards long-term objectives. His statements underscore the complexity of interpreting the economic data in a way that supports sustainable growth without triggering unintended negative outcomes. So I think we are going to carry on this steady course for a while. In my opinion, I don't foresee like a decrease in interest rates if we cannot see like beta inflation figures and better GDP or lesser GDP performances, because 3.4% is indeed too hot for the US economy. So the Fed's policy decisions are far-reaching. I explained this slide on my previous video, but I think that I am presenting against this because we are in this scenario in which we have real shocks. So you can see here that when we have expected shocks, possibly we are not going to see like downturns in developing economies. However, when the shocks are reaction shocks, including unexpected shocks, you can see the damage that this has or the Fed does to other economies. So if the Fed decides to carry on increasing the interest rates, I bet this is going to be bad for the world economy. As we delve into the current economic environment shaped by the Federal Reserve policies, a critical question emerges for savvy investors. With Treasury yields hovering around 5%, does it make sense to buy US Treasury now? I think this decision is particularly compelling given the evolving macroeconomic policies and the uncertain economic forecasts. There might be two scenarios. The first one, inflation coming down slowly and the Fed rate doing so at the same time in a slow step-by-step fashion. From a modern economic perspective, higher treasury yields in a context of cautious central bank communication suggest an attractive risk-reward ratio for investors. So these yields significantly higher than in recent years provide an opportunity for diversification and risk management. That's why we saw increase in the in bond prices together with increase in the stock exchange. Especially in times of economic uncertainty and inflationary pressures, it's always important to diversify the portfolio. However, the attractiveness of these yields must be weighted against the backdrop of modern monetary theory, which emphasizes the government's capacity to fund deficits through money creation. This can potentially lead to a higher inflation. In other words, if Biden decides to carry on with fiscal deficits, or huge fiscal deficits, this might carry problems of high inflation, which will hurt the treasuries for sure. So, and if there is inflation, these conditions could erode the real returns of any fixed income portfolio over the time, making the decision to invest treasuries complex. Loose fiscal policies are like kryptonite, I think, for my investments in treasuries, to be honest. But I hope that they will tame up a little bit. That is, I think, yes, there are many voices now that are claiming for a more cautious fiscal stance to stop the indebtedness of the United States. So investors must also consider the role of international economic dynamics, with the US potentially entering a phase of reduced globalization that I call, or many analysts call, fragmentation, and increased economic nationalism. Implications for the dollar and consequently treasury securities could be significant. So these factors, or the environment factors of is an inflationary environment from the side of many economic shocks, not as much as artificial intelligence that is deflationary, but other factors such as wars and fragmentation is actually inflationary. Ultimately, the decision to invest in treasuries at current yields should be aligned with a strategic view of both macroeconomic conditions and personal investment goals. While current yields offer a tempting income stream, they come with the need for vigilance against potential economic shifts from the Fed that could affect future interest rates and inflation scenarios. To wrap things up, let's reflect on the Federal Reserve's recent actions and the economic landscape they are navigating. Imagine the Fed as a tightrope walker, balancing carefully between fostering growth and controlling inflation. Over the past months, the Fed has been making cautious moves to stabilize the economy by adjusting rates and utilizing tools like quantitative tightening. They aim to support employment and keep inflation in check, but that is not an easy task. The Fed faces a patchwork of conflicting economic signals, from fluctuating consumer prices to global economic uncertainties. So as we move forward, the Fed's ability to adapt its policy framework will be crucial. They need to respond to both domestic challenges and global challenges. For example, shifts in global supply chains or unexpected geopolitical events can quickly alter the economic outlook that I have. Stakeholders across the economic spectrum, businesses to policymakers and consumers, must be vigilant and adaptable. Adaptability, I think, is the key for if you want to invest in treasuries. It's like being part of a dance troupe where everyone needs to be in sync to avoid missteps. By staying informed and ready to adjust, we can better navigate the evolving economic narrative shaped by these complex policies. Please subscribe if you want more videos about these topics of economics affecting the markets. Thank you.